Hi, let's talk about how expertise is required as a nature of the business brokerage and real estate investment.
Nature of business brokerages. Expertise required in business brokerage. Business brokerage operations involve skills beyond those normally required in a regular real estate deal. Licensees planning to specialize in business sales must develop skills in areas of corporate finance, business accounting, and the valuation of businesses. Real estate licensees have the legal option to sell both residential real estate and commercial or business real estate. However, because business brokerage activities do require expertise in the area of business brokerage, it is far more common to see licensees specialize in one or the other. The area of understanding corporate finance and business accounting can be a complex process that varies dramatically from understanding the workings of a household budget, such as taxation for a home buyer. And although the valuation process between residential real estate and commercial or business real estate have components in common, the process of determining value relies on an understanding of buyer preferences as much as mathematics. Much of this understanding is gained through experience and the mentoring from others, and as such is easier to gain when targeting either residential versus commercial or business brokerage, rather than trying to be an expert in all areas. Of course, each licensee must decide for him or herself what path is best to be taken, via it be specialization or intentional conquering of both avenues. Corporate finance. Corporate finances involves issues such as sources of corporate funding, the capital structure of corporations, the actions managers take to increase the value to shareholders, corporate stocks, and budgeting. Working with a buyer of a business generally requires helping the buyer to understand the financial health of the company and the options to use financing to purchase the business. This means analyzing the capital structure of the corporation, such as looking at how much debt the income of the current company is carrying. It means analyzing the current payouts to shareholders and possible areas of improvements. It means digging into budgets to understand issues such as whether reserves have been maintained for large expenditures, such as the need for roofing and paving. Often, the overall analysis requires that the real estate licensee direct the seller and/or buyer to consult with tax, accounting, and legal professionals. Real estate licensees must always be careful not to practice or give advice crossing over into these other licensed fields. To work with investors, it is important to have knowledge of corporate finance. Classes can be taken to learn about issues such as corporate sources of funding, the capital structure of corporations, the actions managers take to increase the value to stockholders and shareholders, corporate stocks, and budgeting. Business accounting. Business accounting involves identifying, recording, and communicating the economic status of a company. A basic understanding of financial statements, such as income analysis statements and cash flow statements, is required. Business accounting consists of three basic activities: identifying, recording, and communicating the economic status of a company. Accountants use bookkeeping techniques to systematically record and report the financial status of a company. Financial statements communicate accounting information. As a real estate professional selling business, it is important to have a basic understanding of these financial statements and how to evaluate cash flow. Remember to stay within the range of your expertise and refer your clients to business accounting experts as needed. Basic financial statements that you will become familiar with in this aspect of the real estate industry involve both income analysis statements and cash flow analysis. Income analysis statements. The income statement is the financial depiction of the income, expenses, and net generated over a specific period, often quarterly or over a year. The income statement is also called a profit and loss or P&L statement and is the most heavily analyzed financial statement to measure the financial health of a business. The primary purpose of an income analysis statement is to report earnings and profit or losses to owners, investors, and potential buyers of the business. It is not advisable to limit an analysis of a business to just the income statement. History has shown that income statements can be skewed, often with the real financial story buried within the footnotes of the report. It also requires speculation as reserves are gathered for future expenditures. Despite limitations, it is often a good way to get an overall view of a business. Cash flow analysis. A cash flow analysis is a look at a company's incoming cash and expenditures. A good analysis begins with the starting point of cash and follows the ins and outs of the money. As noted earlier, cash flow subtracts for debt repayment and interest. Such expenditures could be dramatically different for a new owner. It is especially important for small companies to have a good understanding of cash flow. It is often the shortage of cash for daily operations that becomes the downfall for many businesses. A good cash flow analysis can help to avoid this situation. Valuation of businesses. Estimating the value of a business is similar to estimating the value of regular real estate, in that value can be determined from comparing a business to other like businesses that have sold through a comparable sales approach. A cost approach could also be applied. More commonly, though, businesses are valued based on an income analysis, and often a liquidation analysis is considered. The comparable sales approach and cost approach. Both the comparable sales approach and cost approach for business valuation follow the same process previously explained in regards to valuing regular real estate. Either of these approaches are especially useful when real property is being sold along with the business. Keep in mind that the more unique a business is, the more difficult it is to apply either of these methods. Comparable sales valuation of businesses. The basic place to start in determining value is the comparable sales analysis approach. As with regular real estate, you are looking for similar businesses that have sold. Comparing the attributes of each business, you then determine a close estimation of value of the subject business. Cost approach, valuation of businesses. For a business that involves real estate, it would be appropriate to determine value by calculating the cost approach. This is the same process as with regular real estate. Determine the replacement cost, deduct for depreciation, Add the land value. For a business, remember to add for other assets plus the value of goodwill. Income analysis. For business valuation, income analysis is one of the most accurate methods for placing value on a business. The income approach looks at projected income and compares it to other businesses that have sold. Liquidation analysis. Liquidation analysis is a process of valuing assets of the property should the business be dismantled. To determine a liquidation value, the money expected from the selling off of assets, including any real property, is added to the cash on hand less the debt obligations. This method is often used to value businesses that are going out of business. Understanding is not illegal. It can be a bit confusing when I tell you how important it is to understand something versus crossing over into the job of an accountant or a lawyer or a lender, etc. Here's the difference. Let's say that you have been tasked to find a financially sound business for a potential buyer that has a 10% rate of return on the investment. You find a potential business that you believe that your clients might be interested in if the financials from the company holds up. So you request the seller's broker to release documents to you for your review. At a glance, it appears that the business has a good cash flow and income statement. With your review, you feel comfortable introducing the business to your potential buyer. You make this suggestion based on your own review of the financials. But that's where it stops. You then advise your clients to make his or her own evaluation of the documents, and you advise your client to consult with professionals to ensure that the purchase makes financial sense. In that way, you didn't cross over to the other fields. However, it would have been difficult to know whether to even introduce the property to a client without a basic understanding of the process. And always be careful. Be careful not to fail to introduce a property based on what you review. After all, it is the client that ultimately needs to decide about the viability of the purchase.